Hi guys, welcome back to our class Interest and Commission. So this is the part 2 of the two-part series of the discussion on the interest and commissions. So let's start. So in this second part, we will discuss down payments, gross balance, and current increased balance. Down payment. It is initial payment made when something bought in credit. It is commonly paid by the buyer to the seller in order to secure sale. It is not common that in the event the buyer is unable or unwilling to finalize the order, the down payment is not refundable. If the buyer cancels for any reason, the down payment might not be also returned. So for example, a car dealers normally require a minimum down payment, usually 20% of the total cost of the vehicle being purchased. The interest on the remaining balance is then computed depending on the number of years a buyer would want to amortize the remaining balance. If a car costs 1 million and a minimum of 20% down payment is required by the company, then the buyer will have initial cash out of 200,000. The remaining 800,000 will be amortized monthly, and the amount of monthly amortization depends on the number of years the buyer will want to pay the loan. Normally, buyers prefer a 3 or 5-year payment period. The lesser the number of years, the lesser the amount of money paid as interest of the loan. But with this arrangement, the monthly amortization will be considerably higher than the one chosen to pay the balance for a longer of years. So let's move on to the gross balance or the book balance. Refers to a total amount of money a bank has on deposit before adjusting for uncleared check or deposit, as well as reserve requirements. Uh, and it is the account balance in the company's accounting record. Book balance is the measure of what bank has on hand before adding or subtracting regulatory obligation and items that will soon appear on its book. This is the term used by banks to describe the amount of money available before any adjustment is made for deposit in transit, checks that have not been cleared, and reserve requirements and interests received from float funds. An organization uses bank reconciliation procedures to compare its book balance to the ending cash balance in the book statement provided to it by the company's book. The following reconciliation item commonly arise as part of the bank reconciliation and required adjustment of the book balance. The first is the interest earned, the second is the service charges, the third is the adjustment to deposits, and the fourth is adjustment to check. So the first is interest earned. This amount is recorded in the bank statement and must be added to the company's book balance. Interest earned is when company or a certain person deposited a certain amount of money on the bank, and for the long time or a period of time it will earn an interest on a certain percentage of the money. Let's say for example 1 million, you deposited 1 million to the Bank of Commerce. Then it has a annual interest rate of 0.05. So you will earn a 0.05 interest after a year when you don't withdraw your money on a certain withdraw your money for 1 year and it's still 1 million. So that's how interest earned. The second will be service charges. This amount are charged by the bank for its services in maintaining the checking account and must be subtracted from the company's book balance. This may also include the fees for supplying check stock to the company. Now, service charges usually occurs on a transaction basis. Service charges service charges also charge the bank also charge for the check stock for the company because they produce a check and give to the company who needs check to issue to their clients. Now, service charges usually occur online now because of the pandemic. When you transfer money from bank to another bank uh, which is not on the same bank account, we will have a transaction fee of say 100 or a 25 peso service charge. Now let's move on to the next adjustment to deposits. The company may sometimes record the deposit incorrectly, or it may deposit a check for which there are not sufficient funds. If so, and the bank spots an error, the company must adjust its book balance to correct the error. The bank may also charge an NSF fee, which must be recorded in the company's book. Now, adjustment to deposit occurs like, for example, you issue an you issue a check worth 1 million pesos and the only remaining balance on your account which will be deducted from the check is 800,000. So you need to adjust the deposit in order for the check you issued to be cleared by the bank. So that's how adjustment to deposits means. And the next is adjustment to checks. Adjustment to checks, companies may occasionally record a check incorrectly. If so, the bank spots the error. The company must adjust its book balance to correct the error. Adjustment to checks are just the company have an error on the check issuing to the clients or pays wrong check to the client. So they must declare or the bank record must coincide with the bank by the company's book balance and adjust it in order for them to tally. Example on the gross balance will be seen on the module. Please check out the module that I've sent you. And let's move on to the current increased balance. This may refer to the total amount you have to pay that includes penalties or interest incurred by unpaid balance from a loan or a payment you are supposed to have made but not able to so on time. So in current increased balance are usually done by the creditor or the bank loaner of the bank. Like, for example, you owned a credit card and you didn't pay the annual or the monthly credit card amount to be paid. For example, you have a 10,000 credit limit and you spend 4,000. Then you didn't pay the 4,000 this month and you will incur a penalty plus the interest of the money you borrowed or used on the credit limit. So that's how current increased balance work. So that's it. That's our part 2 of the discussion of the interest and commissions. So thank you for listening and have a great day of learning. Bye bye.